Hello and welcome back to the channel. If you're into real estate investing, today's video is going to be particularly interesting for you. We're talking about real estate options, what they are, how they work, and most importantly, how to make sure they pay off. Whether you're dealing with standalone purchase options or combining them with lease agreements, understanding these strategies can significantly boost your real estate profits. So let's dive in. Let's start with the basics. What exactly is a real estate option? In simple terms, an option gives someone the right, but not the obligation, to buy a property at a set price within a certain time frame. There are different ways to structure these options, and each has its own set of benefits. One common type is the standalone purchase option. Imagine you own a property, and someone pays you for the right to buy it at a set price over the next 15 months. You get to keep the cash whether they buy the property or not. If they decide not to buy, you've pocketed the option fee, and if they do buy, you've likely made a profit on the sale. It's essentially a win-win situation for you. Another popular strategy is the lease with an option to buy. This setup is often used by investors who want to increase their profits from rental properties. Here's how it works. You lease the property to a tenant with an option for them to buy it later. You might charge a higher rent and apply part of that rent toward the option price. This way, you're earning more from the property while also securing a potential sale. But, as with everything in real estate, there are important tax rules you need to know. If the lease payments are too high or the tenant is essentially forced to buy, the IRS might consider it a sale from the start, which could lead to some complicated tax situations. That's why it's crucial to structure these deals carefully. There are three main sets of tax rules that apply depending on whether you're dealing with personal property, commercial real estate, or residential property. For example, if you're leasing out a residential property with an option to buy, you need to be aware of the specific rules that apply to avoid turning your lease into an unintended sale. To help you navigate these rules, here are some best practices. 1. Make sure the option price reflects fair market value when it's exercised. 2. Avoid structuring the lease payments so high that the tenant has no choice but to buy. 3. Do not apply portions of the rent directly toward the purchase price unless structured correctly. 4. Keep the option separate from the lease to avoid the appearance of a sale. 5. Ensure the tenant does not take on ownership-like responsibilities, like making major improvements. Following these guidelines helps ensure that your option remains just that, an option. This not only protects you from unwanted tax consequences, but also maximizes your potential profits from the property. Now let's talk about the tax benefits. When done right, the option payment you receive is your money to keep, and you won't pay taxes on it until the option is either exercised or expires. This gives you cash flow without immediate tax liability, an attractive feature for any investor. Real estate options can be a powerful tool in your investing arsenal, but like any tool, they need to be used correctly. I hope this video has given you a clear understanding of how to make sure your real estate options pay off. If you found this video helpful, please give it a thumbs up, share it with your network, and subscribe to our channel for more real estate tips and strategies. Have any questions? Drop them in the comments below and I'll be happy to help. Thanks for watching, and see you next time.